Imagine checking your bank account and seeing a minus sign. It's exactly $4. You simply forgot a scheduled charge for a cup of coffee. This diagram shows the sequence the bank system follows. It starts with that negative $4 balance. The system detects the overdraft and automatically applies a $35 penalty. Now you're negative $39. Moments later, a $7 subscription attempts to process, fails, and triggers a second $35 fee. Within a single morning, a $4 error has mathematically compounded into a $77 debt. You call customer service, hoping someone can look at the $4 coffee and see the mistake. But the representative on the other end is restricted by the same software you're looking at. They read from a script, inform you that the fees are final, and tell you a manager will call back in 48 hours, a call that almost never happens. It's easy to feel like the people inside the bank are targeting you, or that the system is broken, but the system is doing exactly what it was designed to do. Its foundational rule is that the penalty for having no capital is to be systematically drained of the little capital you have left. We call this Phase 1, automated punishment. It governs almost every account sitting between $0 and a few $100s. This chart shows the maintenance fee threshold. Most banks set a line at $1,500. If your balance sits below that line, the system triggers a recurring $12 to $15 withdrawal every month. At this level, you are essentially paying the bank a subscription fee to hold on to the money you are struggling to keep. When you reach this low balance tier, the bank's internal database categorizes your account as a liability. You appear on the screen as a risk score rather than a customer.
In the physical branch, the interactions are kept strictly professional and as brief as possible. The teller follows a trained protocol that prioritizes speed over service, processing your request in seconds and moving to the next person before you've even stepped away from the counter. In Phase 1, the automated systems exist to extract resources from accounts that are deemed too small to produce profit through traditional investing or lending. When you hit Phase 2, algorithmic profit, the system's behavior changes based on a new data point, consistency. The software detects a regular pattern, like a $2,000 biweekly direct deposit. The automated maintenance fees disappear instantly. You don't have to ask for this change. The system simply recognizes that you now meet the profitable profile and stops the monthly penalties. This flow diagram shows the shift in strategy. Now that the bank knows exactly how much you earn, it begins pushing debt products. You'll start seeing metallic ink envelopes in your mail for credit cards at 22% interest or auto loans at 11%. Service at the branch becomes more proactive. Tellers might greet you by name and offer you a financial review. However, these interactions are still based on automated prompts appearing on the teller screen. In Phase 2, you are more valuable as a debtor than a penalty target. The bank isn't providing a service out of goodwill, it's maximizing the value of your predictable income stream. Phase 3, human exemption, begins when your balance crosses the $80,000 mark and reaches its full form at the private banking levels of $5 to $25 million. This diagram illustrates the systemic inversion. The complex automated flowchart that dictates rules for everyone else is bypassed. Decisions move into private conference rooms, where interest rates and loan terms are negotiated by hand between human beings. At this tier, the bank travels to you. A private banker visits your office with custom reports and estate plans tailored specifically to your family. They bring you opportunities for private deals before those deals are even made public. Because the bank views these clients as having zero risk, the cost of money actually decreases. A millionaire will often pay a significantly lower interest rate for a loan than a middle-class worker with a steady job. This top tier operates on total exemption from the automated enforcement that governs the rest of the world. Rules that are set in stone for the average customer become points of negotiation for the wealthy. At the $25 million level, you are treated as a partner. High-level executives fly across the country to ask for your opinion on market trends, because losing your business would actually impact the bank's annual performance. While that meeting is happening, the exact same institution is keeping a different customer on hold for 40 minutes over a $35 fee. The institution operates on a single axis of math. It applies the same cold, objective calculation to both the billionaire and the person with a negative balance. This mathematical consistency is what creates the appearance of cruelty.
The algorithm doesn't need to be mean to hurt people. It only needs to be indifferent. It will apply a fee to an empty account with the same mechanical precision it uses to offer a private jet loan to a CEO. The individual is the same human being at every level of this system. The bank simply uses the math sitting next to your name to decide whether you deserve a partner or a penalty.